I'll talk a little bit about the U.S. recession and the Fed's response to it. Then we can get into more detail in your Q&A. I think a lot of what I'll say probably is applicable to the UK as well, because obviously facing many of the same issues, and the Bank of England and the US Fed have worked along pretty similar lines through the global financial crisis and more recently. So this is a very unusual recession, obviously. Unlike the global financial crisis, it was not caused by internal imbalances or problems in the economy. It was caused by essentially a natural disaster, an outside shock, namely the pandemic, of course. So many of the things that you would normally expect or believe about a recession are reversed or different from the normal. In particular, there was a lot of talk. I mean, this was very, very deep in March and April because of lockdowns. The US economy contracted at an annual rate in more than 30%, which led people to compare it to the Great Depression, which is really not quite right, since obviously the Great Depression, first of all, the unemployment rate was in double digits for many, many years, and the depression lasted for 12 years. So we're certainly hopeful that this is not going to be a 12-year experience, because we've had good news even last couple of days about vaccines and other public health measures that should help us recover more quickly. So clearly it was a very sharp experience. We don't expect it to be anywhere as long, even I would think, as the Great Recession, but nevertheless, it has obviously imposed a lot of hardship, which I'll talk about. Another difference between this recession and others is the sectoral mix. Normally in a recession, interest-sensitive sectors like housing, automobiles, and other consumer durables, capital investment, and so on are the parts of the economy that take the biggest hit, whereas services stay fairly stable. Here it's just the opposite. We've seen pretty strong housing, for example, but services like restaurants, travel, leisure, entertainment, and the like, personal services, obviously been hit really hard because of the distancing requirements associated with the pandemic. One implication of that, well, by the way, is that the Fed is a little bit of a mismatch, because the Fed normally addresses recessions by cutting interest rates and stimulating the interest-sensitive sectors, and they've done that. As I said, housing has been strong, autos have been strong, manufacturing, capital investment has not been bad, but the Fed has much less power to help the sectors like brick and mortar retail, for example, which are not as sensitive to interest rates, and where the most dominant factor is the health situation. The other aspect of the sectoral mix, which is important, is that while all recessions create a lot of inequality, that is, they tend to hit lower wage workers and lower income communities harder than everyone else. This is even more so because so many minority, lower income workers work in these service sectors, which have been badly hit. So at about the same time, professional workers, many of them are able to work from home and so on. That means that the inequality effects have not been have been more adverse, in this recession than in some others. Now, recently, as suggested by the 30% plus gain in the third quarter, there's been some signs of resilience in the US economy, some signs of improvement, namely, and some of them reflect Fed policy. I mentioned housing and autos, manufacturing. Consumer spending has actually been pretty good, although interestingly, it's focused on goods, things that people can order online, rather than on services, which involve, obviously, being in close contact with people, which is, of course, a problem given the pandemic. That being said, we're still in quite a deep hole in the United States. In 2 months, March and April, we lost about 22 million jobs, and we've gained back, I'm speaking rough numbers here, about 12 million. So we're still about 10 million jobs short. So we still have quite a long ways to go to get back to something approaching full employment. And the evidence suggests that, notwithstanding some good news on the healthcare front, that's going to be a slow process from here, much slower than we saw in the third quarter. Why? Well, first of all, the virus has come back. It's going to be a tough winter. Even if a vaccine is approved, it's going to be probably late next year before it's widely distributed. So public health concerns are going to keep people from eating indoors and going to bars and being in large venues and doing lots of the things that you are familiar with. And secondly, relatedly, a lot of the low-hanging fruit in terms of jobs has been picked. People who work in outdoor jobs or work from home and so on are back to work. It's going to be much slower from here getting people back to work in service industries, which are, based on personal contact. A third reason why things look to be slower going from here is it doesn't look like we're going to see a continuation of fiscal support at the level that we saw earlier. The CARES Act that Congress passed, I think it was in March, provided a tremendous amount of support for people out of work, for small businesses that were in trouble, and provided money to the Fed as backup to allow it to make loans to critical sectors of the economy. So that was a pretty powerful set of tools that were used earlier this year. So far, we've not seen substantial extension, and given the uncertainties of the political situation, et cetera, it's not clear that we'll see much more of that in the near term. So that as those funds are used and spent, that's going to be a potential reason why recovery will be slower from here. And then finally, there are scarring effects, the way the Fed describes it. Some small businesses have gone out of business. People have lost their jobs and have been separated from the labor force. There may be some loss of skills, loss of labor market contact, et cetera. So there may be some long-term implications that will make the recovery slower. Now, let me just say a few words about the Fed and its response, and then we can get into more detail in the Q&A. The Fed's response has been very proactive and aggressive. They have taken the things we did in the financial crisis and built on those things and added substantially more programs and activities than we did 12 years ago. First of all, there was a substantial financial dysfunction in the economy around March, when for a period, nobody wanted even to buy US Treasuries, which are the safest and most liquid security under normal circumstances. And the Fed intervened in a variety of ways, providing liquidity to the financial system, doing what's called currency swaps, where it provided dollars to major central banks around the world so they could unland to their own banks, which often function in dollars. That was something we did in the global financial crisis. Providing help to money market mutual funds that were experiencing runs in March, and in general, providing the liquidity that a central bank is supposed to do. But beyond that, it also served as what we could call a market maker of last resort. In particular, it's bought some $2 trillion plus of US Treasuries and mortgage-backed securities, acting as a final source of demand when other market makers like broker-dealers and the like were unable to provide that market-making capacity. And that has tremendously improved the functioning of the securities markets in the US, which got pretty much back to normal by April and May. Finally, the Fed is acting as a backstop for non-financial credit. We did some of this in the global financial crisis. We had a facility that lent commercial paper to firms, for example. We had a facility that supported asset-backed securities. The Fed has restarted all those things and gone beyond it. And in particular, as you probably know, in the CARES Act, Congress provided the Fed with essentially Treasury equity. The Fed is allowed to make emergency loans under its 13(3) emergency lending facilities, but it can't make loans that it doesn't expect to get repaid. The money coming from Treasury via Congress, which will support the Fed's lending, says basically the Fed is allowed to take some risk, because if it loses some money, that will be made up by the Treasury allocation from Congress. So the Fed has opened a corporate bond facility, a municipal bond facility, and others, and even a facility called the Main Street Lending Facility, which goes through banks to provide credit to medium-sized firms. The latter, the Main Street Lending Facility, I think is still questionable whether it's really working. The terms have been eased several times. There's still not a lot of take-up. The other facilities, like the corporate bond facility and municipal facility, have also not done a lot of lending, but they've been actually quite effective, because by being a backup, a guarantee that the government is standing behind those markets are now functioning quite normally. And so firms and municipalities that want to borrow are able to do so under relatively normal terms. Finally, let me conclude by saying a bit about monetary policy, which is the other area where the Fed has responded. The Fed, before this crisis started, the Fed was involved in a strategy review, thinking about how it was going to structure monetary policy going forward. And it announced the results of that review last August. The review basically has two parts. The first is what's called flexible average inflation targeting. What's the idea? Basically, under regular inflation targeting, as we instituted when I was chair in 2012, if you fall below the 2% target, and you know about this from the UK as well, if you fall below the target, then you just try to get back to the target. Bygones are bygones. You don't try to make up for the previous shortfall. With average inflation targeting, the idea is to keep inflation at target on average over time, which means that if you undershoot for a time, you have to overshoot to compensate for that. So the Fed is basically saying that, with inflation below target for some time, we're going to keep rates lower for longer in order to get inflation at least modestly above 2% for a period of time. The benefit of doing that is essentially telling markets, we're going to be pretty dovish here. We're going to keep rates low for a long time and hope that gives you additional stimulus in the economy. The second part of the reform has to do with employment. Ever since modern monetary policy began back in the 50s and the 60s, the Fed is engaged in what's called preemptive inflation strikes. If they see unemployment getting really low, based on the Phillips curve, there's an assumption that if the economy gets too hot, that inflation is not too far behind. And because monetary policy works with a lag, the Fed has often begun raising rates before inflation has become a problem, just on the basis of the fact that the economy looks to be pretty hot. The risk of that is that if you raise rates too soon, you may prevent the labor market from getting the full benefit of the recovery. And that, of course, is costly for workers. So one of the main things the Fed learned in its review was that a very tight labor market is very beneficial to minority, low-income communities, because that's when the labor market is really hot. That's when jobs are much more available, more people can find work, and that has long-lasting benefits. So the Fed basically decided it was essentially going to get rid of preemptive strikes on inflation and not tighten policy until it actually sees inflation. So that was a change towards a more pro-employment, less inflation-averse approach by the Fed. And I think what makes that possible is the fact that the Fed has had such a good record on inflation for a long time, going back to Greenspan, that inflation expectations are very well anchored around 2% or close to 2%. And so modest overshoots and undershoots of the inflation target are not creating destabilizing expectations. So they provided guidance now, which say basically consistent with this new framework, that they're not going to raise rates until at least inflation gets to be 2%. They'll expect to overshoot modestly, and they'll also want to be sure that we're at close to full employment before they begin the process of tightening. So this is a more aggressive Fed. It should help, but I guess I would also say that, as I mentioned earlier, that low interest rates can certainly help some parts of the economy, but fiscal policy has an important role to play, in particular because it can target those groups, those industries, those sectors that are most badly hit by the pandemic and need the most help. So fiscal policy does have an important role to play, and Jay Powell and Christine Lagarde and most major central bankers have been very clear about the need for fiscal policy to play a role in the recovery. So Nikhil, I'll stop there and just take your questions or conversation.
Cool, yeah. So just going off that last point about fiscal policy, I know in the US, there's been a lot of discussion and gridlock over a second stimulus package. And I know a lot of this is still up in the air depending on kind of the Senate elections and how those turn out in January. But what kind of outlook do you think a new Biden administration will have in terms of a second stimulus package, but also overall in this kind of coronavirus recovery as a whole?
Well, first of all, the most important and highest priority is to get the health situation under control, which is, at the moment, it's definitely not under control. We've had a pickup in infections, hospitalizations, quite seriously. The news about a potential vaccine is very good, but again, that's going to take some time before that becomes widely available. And also, there's more to be learned, I think, about how long the effects are and so on. So President-elect Biden has already put together a team of public health medical professionals to try and guide the near-term response. And that will involve, I'm sure, judicious. There's not going to be a general lockdown, but care about which sectors are allowed to operate, mask wearing, all the various things that we've already learned about, trying to make sure that businesses and hospitals have appropriate equipment, et cetera. So there's a whole bunch of things that need to be organized where the federal government, in the US, the states have a lot of authority and a lot of responsibility for public health. So they'll continue to have important roles, but the federal government can do a better job, perhaps, of coordinating, making sure that states have appropriate equipment and so on. So that public health part is a really big issue. On the fiscal side, a lot will depend on what happens in the Senate. If the most likely outcome, according to prognosticators, of which I am not one, is that the Republicans will have a slim majority in the Senate, which will make it difficult for the new president, to do large fiscal programs. There does seem to be some willingness on the part of the Republicans to do a moderate-sized program, and so that will be under discussion probably in the lame duck period, and then certainly once the new president is inaugurated. So again, probably not the big program that that the Democrats would like, but I hope at least that it will provide some additional support for small business, additional support for the unemployed. The most contentious area, by the way, is help for states and localities. States are under tremendous financial pressure because they've lost income, lost tax revenue, and so on. And in the recovery from the global financial crisis, we had the same problem, that states and localities in the US have to balance their budgets. And so if they don't have enough revenue, they start laying off workers, they start cutting back essential services, including health services. So it is important that they get some support. And again, there's big disagreements between the two parties about how much support or what kind of support to provide states and localities. The other concern for President Biden is that he obviously has other ambitions, including infrastructure, including climate-related work, building solar panels and the like, issues related to equity and racial justice, a whole bunch of things, climate I mentioned. So he's going to have to make some tough trade-offs if he doesn't have a majority in the Senate, unlike Obama, who did have a majority when he first came in. He's going to have to make some tough trade-offs working with the Republicans to try to figure out what his priorities are in terms of fiscal policy.
Fair enough. Also, I know a lot of the Fed's liquidity facilities are set to expire at the end of this year, and we'll probably hear more about this in the Fed's meeting in December. But do you think with a modest stimulus package, assuming Republicans keep control of the Senate, that the Fed will still have the sort of ammunition, so to speak, to be able to continually support the recovery of the United States economy?
So on the programs, like the corporate bond and the municipal and Main Street lending facility and so on, as you say, I believe that they expire at the end of the year and they need to be extended. There's a very strong case for extending them. The only reason they wouldn't get extended would be because of political disagreements between the outgoing and incoming administration and the Treasury and the Fed. So I hope that they are extended. But I recognize that there's some question there. The Fed still has a lot of its other lending authorities that don't rely on that CARES money. For example, the swaps, the commercial paper facility, other things that it can do to help. And also, I think the Fed still does have some monetary policy room. It's still got some room to do. It really has not given us much guidance about its quantitative easing asset purchase program. It could do more there if it decided to. It can provide more explicit guidance on rates. There are other things that it could do, but it is true, as I said earlier, that in this particular recession, fiscal policy is important, both because it provides extra firepower to help recovery in general, but also because this recession is so different and unusual, it allows for more targeted responses to those sectors or groups of people who most need help. So I'm hopeful that a substantial fiscal program will be available. But the Fed certainly is going to, it still has some powerful tools, and it will continue to do all it can to support the recovery.
So just talking about the Fed a little bit, I know there's a lot of, like in the news, on forums online, a lot of discussion about the Fed's balance sheet. I mean, I think recently it got up to 7 trillion, I believe. Is there any reason to be worried about this? Or is this just a normal part of the recovery that will start to shrink as we sort of get out of this?
Yeah, no, I don't think there's any reason to be worried about it. 7 trillion off is about a third of US GDP. Bank of Japan has got a balance sheet bigger than GDP. So it's nothing terrible happens. The Fed does have that scope to expand its balance sheet. In fact, it found when it got down to about 4.5 trillion that was probably too small, because at that point there weren't enough reserves in the banking system to prevent disruptions in the repo market. So the Fed actually began to increase, from that level. So no, I don't think we're anywhere near anything that would be considered a limit. On the other hand, what will probably happen, although some years down the road now, will be, once the economy's back at a healthy condition and the Fed wants to bring policy back to a more normal state. I mean, the first thing it will do is stop buying, to stop increasing the size of the balance sheet. Then sometime later, if it follows the same pattern that I and Janet Yellen followed, it'll wait until it's able to raise the funds rate a bit to get away from zero. And at that point, it will probably allow the balance sheet to begin to run off, so it begins to shrink back down to where it was, somewhere close to where it was before the crisis started. Now, one thing to note is that the Fed has been buying Treasury securities of all maturities. So, like a third of the securities that it's purchased are relatively short maturity, 2 to 3 year maturity, which means that they'll run off pretty quickly. So just simply not replacing maturing securities, once that process begins, will bring down the balance sheet over time, and maybe a little more quickly than was the case with the balance sheet that was built up under my tenure and under Janet's tenure.
So moving, I guess, still within the Fed, I know recently they haven't made a decision on to change the kind of federal funds rate where it's at right now. But there also has been a lot of discussion both in Europe, even in the UK, about kind of going into negative interest rates. And I know a lot of senior Fed officials have also said that's kind of off the table for now. Do you think negative interest rates are a thing the US could use? And also kind of, do you think they're effective like in the UK and in Europe as well?
Well, I think the evidence in Europe is that they have been moderately helpful. They give a bit of extra space, for policy to ease. I think the concerns in Europe about the effects on the banking system are somewhat overstated. The banks have benefited from a stronger economy and from higher asset values on their balance sheets. So I think in the case of Europe, it's been moderately successful. It does depend a bit on the financial institutions that you have in your particular country. The UK has been slow to do negative rates, I think in part because they worried about the effects on their banking system, which is a very big part of their economy. The US has worried, more interestingly, not so much about banks, but about money market mutual funds, which promise to pay dollar for dollar back to their investors. So the risk of breaking the buck, that is paying back less than $1 per dollar, is what led to some runs on money market funds in 2008 and even in this year. So there was concern that negative rates would have bad consequences for the stability of money market funds and so on. I think more generally, I think people tend to get kind of freaked out by negative rates. They don't understand the idea. So from a political and public relations point of view, it also presents some problems for central banks. That being said, I think that that they can provide some help under certain circumstances. If you are stuck at zero, both short-term and long-term, and you have no other space to increase policy accommodation, is something that should be considered. Now, having said all that, like you said, the Fed has looked at it. We looked at it when I was chair, and there's just not a lot of enthusiasm for the idea in the United States. And so, while you can't rule it out forever by any means, I think if the U.S. got stuck into a situation where rates were basically at zero across the term structure and there was no other policy available, they would have to consider it. But on the most likely scenarios going forward, I think that the Fed will look at other things before it turns to negative rates.
Kind of piggybacking off of that, do you think in the long-term economic outlook, both for the US and the world, kind of this new Fed approach of average inflation targeting, do you think that has kind of consequences for how high up we can now bring what the rate is now, but rather when we're on kind of an economic upwards trend? Do you think this average inflation targeting will allow us to bring the federal funds rate up more so than we would be able to if we just wanted to stay at 2%?
Maybe a little. In the short run, it means lower for longer. It means rates will be easier and lower for longer because the Fed is trying to overshoot the inflation target. But one of the main goals of average inflation targeting is to keep inflation expectations tied, anchored at 2%, not below that. I mean, so there's a concern. I think in the biggest problem faced in Europe and Japan is that their inflation expectations are too low below target. And that makes it hard. That in turn brings down interest rates and reduces the scope for monetary policy. And so that gives you a sort of a vicious circle, which Japan has been stuck in now for a number of years. So if average inflation targeting keeps inflation expectations at around 2%, which is the goal, and fortunately we're not that far away from that now, that will mean that the neutral interest rate, the interest rate they can get to as they come back to a more normal configuration, will likewise be higher than it otherwise would be if, say, inflation expectations were 1%. So roughly speaking, if you think that the Fed currently seems to think that the real neutral interest rate is about 0.5%. So in normal long-term sense, if you look at their projections. So if you add to that 2% inflation expectations, you get sort of 2.5 or so is kind of the neutral or normal interest rate. That's, at least based on current Fed estimates, that's kind of the range where they would hope to get back to. And they almost were there before the crisis as they try to normalize policy in the future.
Cool. Moving this discussion a little bit towards financial institutions and financial regulation a bit, because a lot of questions that we had from people who registered were about these topics. Do you think kind of this COVID-19 crisis has kind of exposed any big flaws within the financial institutions, whether it's in the US or whether it's globally?
Well, I would say, first of all, I think that the banks so far look pretty strong. We built up a lot of capital, a lot of liquidity in the banks prior to, after the global financial crisis. And of course, this, unlike the global financial crisis, this recession was not caused by problems in the banking system. So the banks have come in fairly strong, and they, of course, are a pretty important part of the financial system. But some other parts we've seen some concerns. In particular, the dysfunction in the markets in March was quite severe and suggested that parts of the so-called shadow banking system, the repo market, the dealer market for treasuries, the bond funds that were essentially run upon by some of their investors, money market mutual funds, these other parts of the shadow banking system came under a lot of stress in March, and the Fed basically had to intervene on a very big scale in order to stabilize that. Now, fortunately, not major damage done to the economy. The Fed got that under control, but clearly the time will have to come when the Fed will look at, what went wrong there and where do we need to not just the banking system, but the so-called shadow banking system, those institutions which are not part of the Fed safety net of this discount window and deposit insurance, et cetera, that they also are stable. And I think there's some real issues that need to be addressed there.
So moving a little bit towards financial regulation, do you think this Biden administration and kind of the tougher stance it has towards the financial industry as a whole, as part of kind of the Democrats' platform, will have any long-term consequences on kind of the way the Fed is able to enact monetary policy, but also just within the US financial system as a whole?
Well, I think that having a tough regulatory policy is a good thing. First of all, financial crises can be, we learned the hard way that a financial crisis can have really bad effects on the broad economy. And so reducing the risk of that is really important. And in a way, as I said earlier, I think we did a lot of good work in the banking sector. Maybe more could be done. But some of the shadow banking sectors where a lot of the problems were in the global financial crisis still need further work. So I think that reducing the risk of a financial crisis is obviously should be a top priority for any administration, and I hope that they will focus on that. Related to that is there's sometimes an argument that the Fed should not be, let's suppose there's still a meaningful amount of unemployment. Sometimes, and the Fed wants to lower interest rates in order to help with that situation. Sometimes you hear critics saying, well, you can't do that because that'll create more financial risk. It'll create bubbles, or it'll create problems in credit markets. And I think if that's true, that's really bad news, because monetary policy is here to try to help people in the economy broadly. And if problems in the financial sector are preventing the Fed from doing what it needs to do to help the economy, that's a problem. So my point is only that if you can strengthen regulation and oversight to make the financial system more stable and more resilient, then there'll be less of this argument that the Fed can't, use easy monetary policy to help put people back to work, and that will be, I think, give the Fed more flexibility, because they did actually in their flexible average inflation targeting, they put in the proviso that if there are other risks, which is code for financial stability risks, that emerge, that might short circuit their efforts to keep rates low and provide maximum employment, and that's a bad outcome. We want the Fed to be able to do what it has to do to help the economy. We want strong regulation and oversight to do its job to keep the financial system stable, even if interest rates have to be low or for whatever other reason.
So then how does the Fed kind of walk this line during a crisis? As for right now, I think Eric Rosengren was talking a lot about how the Fed needs to take a tougher stance against excessive risk taking. And I think that's easier to do when you're not in a crisis time. But if you are in a crisis like now, how does the Fed kind of walk the line between kind of taking steps to ensure that there isn't excessive risk taking, but also ensuring that it can kind of fulfill its mandate and be able to provide the liquidity and the financial assistance that the economy needs at the same time?
Well, that's the analogy I think about is what happens if there's a building with a bad fire code and it catches on fire. You don't start having bureaucratic meetings. When you see the fire, first thing you do is you put out the fire, then you look at the situation and you try and put in new rules, new regulations, new oversight to make sure that the fire code is up to date and people aren't doing things they shouldn't be doing. I think the same thing is true here. I mean, I think in March, the Fed had no choice but to intervene powerfully to try to make sure that the markets were functioning, that credit could be extended. If they hadn't, it would have had very negative consequences for not just for investors, but for the whole economy. So it's important the central bank was created to be a lender of last resort, to be a bulwark against financial crises. So that's in some sense, its job, and that it has to do that when those situations are sufficiently serious that they endanger the entire economy. But that being said, it needs also to, once the fire is out, speaking, metaphorically, it then needs to go and make sure. And again, this obviously has to be done in cooperation with the Treasury, with other agencies, and with the Congress. Make sure the rules are tough enough that the system is resilient and doesn't crack, when there is some kind of shock. So that's how I think you do it. You have to play your role as firemen when that's necessary, but I'm in favor of tough regulation to make sure that the system is not a source of problems for the economy, rather that it's a stabilizing force.
So then, kind of discussing this post-COVID world, kind of where the fire's out, do you think there are any large kind of changes in consumer behavior that we're going to see post-COVID in terms of people going out willing to shop, people shopping online more, kind of if there'll be a savings glut and if people are more willing to save now? Do you think any of these potential, I know it's a lot of speculation still, but do you think any of these changes will have impacts on kind of the way federal banks and the Federal Reserve and central banks around the world kind of enact monetary policy?
I don't see any major changes for monetary policy. Yeah, there may be some changes in people's shopping habits and their willingness to work from home. We may have learned a few things about, maybe not, about online education, for example, as you're experiencing. I think one, so again, there'll be some sectoral changes, and that might affect a little bit the way monetary policy affects the economy. So I don't see any really big shifts. You mentioned also precautionary savings. Maybe people will spend a little less, although there's not much evidence of that so far. I mean, there's spending is held up on the whole pretty well. I think one thing we learned that's interesting to discuss further would be when Congress passed the CARES Act to provide money to the unemployed and to small businesses and so on. As a bureaucratic matter, it took a really long time and it was really difficult to get the money out. And some people have argued that the central bank, the Fed, ought to offer some kind of digital account to every American, which would make it procedurally much easier to get money out if you had a fiscal program like that. So that's something I know is being discussed, and Jay Powell just had a speech about it. There's some considerations on the other side, and I think the Fed is a little bit leery about essentially injecting itself into what is now a private sector activity, the banking system, payments, deposits, and so on. It also doesn't want to be a source of financial instability if people see the Fed as a place to run, if they're worried about what's happening in the private sector. So there's a lot of things they're talking about, a lot of technical issues they're talking about. I don't know where that's going to come out. Don't have a strong position on it. But thinking about how to make our fiscal system a little less rickety, and the Fed is actually what's known as the fiscal agent, is actually responsible for a lot of the payments that the federal government makes, processing them as part of the Fed's job. So it has, I think, work to do in terms of how it's going to be thinking about payments and particularly fiscal payments in the future. So that's one area where I think there's a lot of discussion going on, although I can't at this point say exactly which way it'll go.
So I just wanted to discuss a few things that have been talked about a lot in the news recently. So I know one thing a lot of people have talked about, especially in regards to the current election, is how there's this kind of widening disconnect between what Wall Street or the stock market shows and kind of what economic figures show. And there's also been some discussion about is the Fed really playing a role in inflating asset prices, especially in the stock market? Do you think this is a relevant concern? Do you think the Fed is inflating prices, or is this kind of a lot of fear mongering?
Well, one thing about the stock market is everybody always has a strong opinion about it, and nobody really knows that well exactly, what the stock market is going to do, because the stock market, of course, embodies expectations about the distant future, and our ability to predict the distant future is not very good. That being said, I think I can understand why people sort of say, oh, it's a puzzle. The economy lost 30% in the second quarter and the stock market is back to where it was. How can that be? It's not that puzzling when you look at the details. First of all, the stock market, the US stock market, is very different from the US economy. For example, small businesses, which have taken a big hit, small service sector companies, and a lot of the areas, sectors that have been most affected by the coronavirus just don't have a heavy weight in the stock market. The stock market is the biggest companies in the stock market are the high tech companies like Amazon and Netflix and Facebook and Google. And we know how they've done. They've done actually quite well in this for various reasons, because they're not contact related, they're distance related. So the fact that the stock market reflects the profits of a set of companies which are not really representative of the whole economy, that alone is a big explanation for the difference. Second explanation is the stock market is by its nature very forward-looking. And as I said at the very beginning, we had a very sharp decline in March and April, but the expectation is that as we come to grips with the public health problem, whether it's a year or 2 years or 3 years, eventually the economy will go back to something closer to normal. And so this is not a permanent reduction in profits. It's a reduction which will last a couple of years, but at some point we would expect to see profits coming back. Stock market is forward-looking. It responded very well to the vaccine news, but that just indicates that it's thinking about the future, not about today. And then, of course, interest rates are low, but that would make you expect that the Fed the stock market is going to discount future profits at a lower, in other words, it's going to have a longer time frame effectively when interest rates are low, because it's not discounting future profits to the same extent. So I don't find it grossly puzzling that the stock market has gone back sort of to where it was, roughly speaking, before the crisis. I think the main reason for it is that low interest rates do help it, but also the fact that the stock market and the economy are quite different. And the problems that many people in many sectors in the economy are having are just not reflected very much in stock prices.
So kind of talking about the recovery that we're looking at, I know a lot of people have talked about whether we'll have a V-shaped recovery or kind of longer, more like 5 years plus recovery. Do you think if we do have a V-shaped recovery, and I know this is, again, a lot of speculation, that'll have any serious consequences on kind of the Fed's role in setting inflation expectations and whether the kind of low rates they have promised to stay at, if we do have a V-shaped recovery, will kind of have an impact on inflation looking forward into the future?
Well, as I said at the beginning, we've come back about halfway pretty quickly as people were able to go back to work in some sectors. But I do expect it to be a slower slog from here. Somebody said that this recession is like going down on an elevator and up on the stairs. And the stairs are getting steeper at this point because it's going to be harder to make progress. Although, again, the public health situation is so central. I think the important thing to understand is that the Fed has tied its policy to the state of the economy, to what's happening in the labor market, what's happening to inflation. So are there scenarios in which rates would stay at zero for 3, 4, or 5 years? Yes. If the economy is very slow to recover, if inflation stays below target, then the Fed will keep rates low for a long time. But if inflation, if in a really good scenario where, let's say that the vaccine is very effective and quickly distributed, and we're approaching more normal economic activity by late next year or the year after that, then the Fed would not keep rates low for so long. It would respond to this changing economy. So I think one of the main things that we've learned is that when you give forward guidance, that in most cases, it's helpful to have the policy guidance tied to the state of the economy, and that's exactly what they've done. So if inflation were to go back to 2%, in the next year, then that would certainly affect the timing of their first rate hikes.
So I guess also as we kind of near the end of time here, there were a couple audience questions I just wanted to make sure we get to. So the first one is kind of, the ECB has talked a lot about this lately, and there's been a couple of things said from other central banks around the world in regards to this area of sustainable finance and whether central banks have a role to play in kind of climate change as a larger area. I know the US Federal Reserve hasn't explicitly talked about this much or taken part in any major agreements made by other central banks around the world. So I guess the two main questions here I have are, do you think this is an area that the US Federal Reserve should get in? And then sort of also, is this within the mandate of the US Federal Reserve? And is there kind of a ethical play that the Federal Reserve should be making that it's not doing right now?
So let's first of all stipulate that this is a major challenge for all of us. And it's extremely important that we as a society address the climate change issue. The Federal Reserve differs in terms of some of its authorities and responsibilities from other central banks. So, for example, when making monetary policy, and I'm not talking about these extraordinary lending facilities, but under normal monetary policy, the Fed only buys basically government guaranteed securities, treasuries and GSE mortgage-backed securities. It can't really, get into buying, broad-based corporate bonds or so on. So unlike the ECB, which has a broader mandate in terms of what it can buy, the Fed just doesn't have, in making monetary policy, the Fed just doesn't have the decision about whether we should buy, sustainable, socially responsible securities, et cetera. I mean, it can only buy this limited set of things, basically treasuries. So on the monetary policy side, it just doesn't come in very much. It could come in to some extent on the regulatory side. For example, Mark Carney, who was, of course, head of the Bank of England and is now, I think, working with the United Nations on climate change issues, advocated that climate change creates risks for the financial system. If banks, for example, or insurance companies are affected by hurricanes and floods and natural disasters that affect the value of various properties, et cetera, et cetera. So one of the things that Bank of England did was in stress testing their banks, they include as one of the risks that banks ought to pay attention to is to what extent would climate change or climate change policy or mitigation affect the profits or the capital of those banks. So Powell was actually asked this question at his press conference a few days ago, and he said that they're looking at that. So that's certainly something that would be within their mandate, would be to make sure that the financial system, which they have oversight of, is secure, is got sufficient capital and sufficient risk management to make sure that it's not badly damaged by these climate change issues. The broader issue of advocating, they can also do research. A number of the regional feds have had conferences where their economists have done research papers about climate change, how it affects the economy, what can be done about it, and so on. So there are various ways that the Fed can play in this, in this area. But the truth is that, while it can make a contribution, as a practical matter, the Congress and the fiscal authorities and other agencies, like obviously the Environmental Protection Agency and so on, are the democratically legitimate authorities that should be looking at this. I hope they will, again, but they're the ones who should be taking the lead, and the Fed can be supportive on the regulatory side, but can't really be the leader on this issue because they just don't have either that mandate or those authorities.
So do you think then that it's kind of the role of future administrations, maybe the Biden administration, maybe further, to kind of ensure that this is a part of the Fed's mandate, or that it should just rather be kind of legislative or executive role that should be doing most of the heavy work, and the Fed, like you said, just kind of sort of follows along?
Well, again, on the monetary side, it's not clear how the Fed could do much on this dimension unless it was given the authority to buy a whole range of other assets, and then on top of that, instructions about how to relate those assets to climate change. So I think that's kind of a stretch. It's reasonable for the Fed to incorporate climate change considerations into its regulatory policies. And that's certainly something that the Biden administration and its appointees can take seriously and look at carefully. I think the Fed, again, is already looking at that. And the question is, how would they actually incorporate it in practice? But I think, again, what we need here, and I've been a public advocate of a carbon tax, for example, that would reduce the incentives for companies to pollute with carbon, or to support new technologies, or create new infrastructure that is more climate friendly. All those things are primarily fiscal responsibilities, and it's just much more direct, if possible, to go through that route. So, and moreover, I think there's also, I should just add, a very big international dimension. If the United States, for example, were to be carbon neutral, that'd be a very positive thing. But if the rest of the world didn't change, it wouldn't solve the problem. You need to have international coordination and cooperation, and the United States needs to play a role in getting that cooperation.
So then, more broadly, talking about kind of fiscal responses, I know you mentioned a carbon tax. Based on kind of the administration and the breakdown of Congress that we're looking at, I know there's also a lot of other big pieces of legislation like the Green New Deal and other sorts of things progressive Democrats have brought up. Do you think any one of these is sort of better than the other in terms of kind of the economic impact it'll have along with the emissions impact it'll have? Or should we kind of take emissions first, because that's like the most pressing problem kind of framework, and then kind of talk about the economic impacts?
Well, so what a carbon tax does, the advantage of it is that it can get you however much reduction you want, the cheapest possible way. So, there's no reason to spend more than you have to get to neutrality or wherever your goal is. So that's one of the advantages of a carbon tax. Also, from my perspective, and again, at this point, you're getting outside of my comfort zone, but my perspective, the two main elements of a successful carbon policy would be a carbon tax or some other kind of way of incentivizing companies and people to use less carbon, plus support for development of carbon reduction technologies. Those are the two key things, I think. And so a carbon tax is not it's not a compromise or a sacrifice. You can get whatever level of reduction you think that the scientists think is necessary by changing the size of the tax. So it's not a question of whether you're aggressive or not aggressive. It's just a question of trying to get a given amount of carbon mitigation without imposing more costs on the economy than necessary. And I think that most people should find that pretty reasonable. I think the main question with the carbon tax is that people have to understand that if you just impose a carbon tax and don't do anything else, then the concern is that it might be, there's a debate about this, but it might be regressive. People driving to work are paying a higher gas price, and they don't like that, understandably. So a big part of the carbon tax issue is, what do you do with the revenue? Do you just rebate it back to everybody on a per capita basis? Do you use it for infrastructure? What do you, to build new carbon neutral technologies? So that's one of the big issues that is kind of left, undetermined, and that's an important part of the policy. How you use the revenue you would get from a carbon tax.
Okay, cool, thank you. And then just finally, last question, kind of related to the balance sheet discussion we had before, but a lot of emerging markets and developing countries have been taking on kind of record levels of debt, and a lot of it is in dollars. Do you think this will kind of have any immediate or long-term consequences, especially if a lot of it is dollar-denominated debt, especially for developing countries and developing economies?
Well, we saw some financial crises in the 90s, from emerging markets, and we hope that there were some lessons learned from that, and some of those economies have done better. Some of them have strengthened their financial systems, have strengthened their economic policies, and so on. So it remains to be seen. It's true that there's a lot of emerging market debt, and the IMF and other international agencies have been trying to talk about debt relief and trying to give some help to, at least even if they didn't have the debt. Emerging market economies don't typically have the resources or the healthcare systems that advanced economies have, and they're being hit pretty hard in many cases by the pandemic. And so helping them financially through healthcare assistance through other ways is obviously an important humanitarian goal for the advanced economies. The fact that a lot of this debt is in dollars does put responsibility on the Fed. The Fed has been doing a lot to lend dollars to other countries or provide a repo facility where foreign countries with dollar reserves treasuries can come borrow dollars against those reserves. So the Fed is trying to provide dollar liquidity, which is important. And it's also important, as we learned during my time, that the Fed be pretty transparent and try to give a lot of guidance about how its policies are going to evolve. And that gives the emerging market economies a little extra time, a little extra forewarning how they're going to prepare and so on. But it's certainly a difficult problem. And again, this crisis is kind of like a big natural disaster, which is striking down, a lot of countries whose policies going in were actually not so bad, but now they're facing a very, very heavy challenge, both from a health perspective and from a financial perspective. And, I think advanced economies should help where they can, although many of the advanced economies are also feeling a lot of stress. So it's a tough situation. It is like the global financial crisis. It is a global shock, and it's going to have global consequences.
So then just one last thing. Do you think the Fed's new approach of average inflation targeting will have any implications for a lot of this dollar-denominated debt, in that if we do move to kind of higher interest rates in the long term, will that place a lot of pressure on developing economies who have a lot of their money in dollars, or a lot of their debt in dollars?
Yeah, it's hard to say. In the past, it's been Fed tightening that has created stress, not Fed easing. So the extent this delays the tightening, it might have a marginal benefit for dollar-denominated debt, but it's really hard to say. I think a lot will depend on what's happening in the country, what's happening in the health situation, and in terms of the economy, how it's responding. Those factors are going to be more important than the denomination of the debt.
Cool. Thank you so much for your time. It's just hit 6, so that'll be the end of the event for now. But just for our members, thank you all for coming again. Next week we have 2 events. One on Wednesday with Michael Ross, and then one on Friday with Richard Wolff. Both events will be from 5 to 6 p.m. And they'll be posted soon, and you'll be able to see them on Facebook. So feel free to join us then. And then again, thank you all for coming. Thank you, Dr. Bernanke, for letting us host you. And I hope you have a great rest of the day. Thank you.
Thanks a lot.